This conference will now be recorded.
Good morning, everyone. My name is John Shield, Vice President of Heartland LTC, and I'd like to welcome you to the fourth episode of LTC 101, a series of educational webinars on the long-term care insurance marketplace. Today, we're going to look at overcoming objections, how we can help the customer come to a better decision about long-term care policies by answering their objections head-on. We're going to be discussing some of the most frequent objections that we've heard in the marketplace today and offering a few suggestions on how you can help your client get over them. Before we get started though, as we've done with each episode, I'd like to tell you a little bit about Heartland LTC. We have been in the long-term care insurance marketplace for over 25 years. We are your one-stop shop for all your long-term care insurance needs. After we're done today, we hope that you'll reach out to us with questions about clients you work with that could use long-term care, either in the Q&A at the end or after the webinar is over. Give us a call or drop us an email. We'd love to hear from you. So let's get started by listing some of the objections we most often hear. These are the things that we've heard from our field force as far as the most common objections to why they don't want to purchase long-term care. The first objection we hear a lot is, I don't think I'll ever use it, or I won't need long-term care. We also hear it's a companion objection, I'll lose it if I don't use it. So either they don't think they're going to use it in the first place, or they as a result they think they're going to lose whatever money they've put into the policy. These two excuses both boil down to the same thing, buying something that they think they're never going to use. Next, we have excuses regarding underwriting issues, things like, with my health, I won't be approved, or the underwriting process is too long or too invasive. Both of these excuses have a couple different ways that they can be solved. Our next two involve who is actually going to provide the care, such as the government will take care of me, I don't need long-term care insurance, or my family will take care of me, I don't need long-term care insurance. Both come up a lot, and both are based on some misconceptions, and we'll go into those in more depth. We've also had to deal with bad press in the recent, in the past here, a few years, where the carriers have made some rate increases that have occurred. So I've heard of bad rate increases in the news that I don't want a policy that's going to cost me a lot more in the future. We have some great statistics on this that'll help you out in that regard, and we'll be discussing those in today's webinar. And finally, the universal excuses that everybody uses whenever they're purchasing anything, I'll have to think about it, or I can't afford it. And we have some answers to those as well. These 9 excuses are all going to be discussed over the course of today's webinar. So without further ado, let's go ahead and get started with, I don't think I'll ever need it, or I don't think I'll ever use it, or I'll lose it if I don't use it. Let's start with some facts first off to get this thing to kind of overcome this particular objection. First, 69% of adults will need some form of long-term care, be that a nursing home, an assisted living facility, adult daycare, home health care is even in this category. 69%, nearly 7 in 10 people. So ask your clients if they feel comfortable with those odds, because those odds are obviously stacked against them. Furthermore, 65% will wind up spending an average of 2 years in a nursing home facility. That is 24 months of benefits that they are going to have to figure out how they are going to pay for. So let's take a look at the cost of that very quickly. We'll stick with Arizona's figures just for the sake of this, and we'll stick with a semi-private nursing home room, which is the least expensive option in a nursing home. So they're going to have a roommate that they aren't going to control who that roommate is, and we're going to be in for Arizona on an average cost. Remember, there are states that are more expensive than Arizona. There are states that are less expensive than Arizona. And I'm actually using the statewide average for Arizona. If you remember our earlier episodes, we talked about how even just the different regions within the state can be more expensive than specific statewide numbers. So taking all that into account, we're going to look at a monthly expense of $6,433 per month for a semi-private nursing home room in the state of Arizona. Now, we've just said 2 years. An average of 2 years is going to be spent in a nursing home facility. So that works out to $154,392 is going to need to be spent to cover their cost of care for that facility. That is a significant amount of money and way above what they would be paying for a long-term care insurance policy premium-wise. If that still doesn't convince them to take another look at purchasing a long-term care insurance policy, there are some other ways to overcome their excuse as well that actually kind of leans into it rather than tries to get over it. First, we could use looking at an asset-based solution where there's a life insurance policy as the chassis and a long-term care component has been added to it. If they don't use the long-term care in this scenario, they still have the life insurance policy. There's a death benefit attached to it, and now some beneficiary is going to get something out of the policy. We could also examine our return to premium options, which we talked about extensively in a previous episode. Specifically, the full return of premium options available from National Guardian Life, which can actually provide almost like a death benefit, like the asset-based solution does, to a beneficiary as well, even if claims have been paid out on it. It's highly likely that clients will need some form of long-term care. That 69% up there is a pretty high number. But if they're convinced that they won't, and they don't accept the stats that they will be needing it, these two options, the asset-based solution and the return of premium options on the traditional, may offer a way around this particular objection for your clients. Our next excuse, let's get starting some of the other ones that we have here. With my health, I won't be approved. This one can be a bit tricky. People are inherently private about their medical history, their medical health, and the industry is on their side with things like HIPAA protections, the Health Insurance Privacy Protection Act. But if you have a client who's willing to provide you with some more details, we might be able to get over this particular issue. First, I'd say that you'd be surprised at what is an acceptable health challenge these days for the carriers. Clients who've had cancer in the past can actually still get standard rates now. Recreational marijuana use for another, that this is increasing. They're in for possible standard rates there as well. These are no longer things that are kicking you out or knocking you out of the system entirely. So how do we actually get around this particular objection? Well, let's start first by actually looking at what their medical issues are. Let's pre-qualify them. The more information that they can provide on their current health, the better. Things like their current and previous health challenges, what they've been diagnosed with, the dates that they were first diagnosed, what treatment they've had, if any, and the current status of their condition. We can submit all of that information to underwriters at all the carriers for an informal review of their status. This is also done anonymously. Their name is not attached to this, so they don't need to worry about them having this on their record permanently down the road. The underwriters we actually submit to will actually review everything, and these are the same underwriters that could potentially be reviewing the case once an application comes in, as we're looking at the same group of people that are looking at the same rate books and underwriting guides and all that. They will come back with what they believe is the best area to go to. Now remember, this is just a pre-qualify. It's a pre-qualification. It is not a formal offer. Based on full medical underwriting review is when a formal offer will come through. Because we don't know exactly what's in the medical records, we have to wait for that. But these will give us some idea and a pretty close idea if they can be pretty accurate about their information and all their conditions with what the underwriter was going to offer them down the road. This can help allay their fears if they're not going to be approved or if they don't feel that their health is adequate enough to apply in the first place. We can also get to a better idea of what premium is going to be needed to support the amount of care they're looking to get, because now we know what underwriting class they're going to be in. We can accurately run a comparison, an illustration, and a quote. Alternatively, we can find a product with reduced underwriting. If something comes back in pre-qualification where their underwriting is not going to be favorable to them, where they actually do have a health challenge that traditional long-term care might not be able to get around, we can get an annuity-based LTC plan in, or perhaps a home health care solution that is a short-term care solution that may offer better success rates as making it through underwriting, because the questions are far limited regarding the underwriting that's required. So if they are experiencing some serious health challenges, those options may be a better way to go. If they're not, or maybe they only think they are, doing at least to pre-qualify will let us know one way or the other, whether or not we can actually get them a traditional long-term care plan through normal underwriting that they didn't think that they would be able to apply for, or whether we actually do have to look elsewhere and avoid us having to go through a lengthy application process only to wind up with a decline or postponement down the road. Another underwriting related objection is that the underwriting process is too long or too invasive. Too invasive. Clients don't want to have their medical issues reviewed with a fine-tooth comb. We understand this. Some people are very private. They do not want their medical information out there, and they think it's too invasive, or they feel this underwriting process is going to drag on for months before they actually wind up getting a policy. Well, underwriting has changed a lot in recent years, and it might not be as invasive as they think. And it's even better if they're actually on the younger ages. If you've been following our emails over the last few days, we've been sending out some series of things on when is the best time to sell long-term care. We've kind of been narrowing it down. There's some more of those coming this week. Let's look at the requirements for a client that is applying under the age of 65. Their requirements are as follows: a phone health interview, a pharmaceutical report, an attending physician statement from their doctor or doctors if they've seen some specialists, and the Medical Information Bureau report. But really, when you look at that list, the client is only responsible for the first one, the phone health interview. All the other requirements are obtained by the carrier themselves without anything else needed from the client. There's one exception here. There may be a records release form that's needed for that APS, depending on their doctor. This is usually only a single page form, though, that is just their signature at the bottom and name and address at the top, usually. Most doctors operate off of the existing release that's built into the carrier application packet, but some doctors do have a special release form, such as Kaiser Permanente in California, and a couple others that are scattered even here in the Phoenix Valley area. Some doctors groups require that their own form be used rather than a generic. If the client is over age 65, so this was for under age 65. If a client is over age 65, the phone health interview is replaced with a face-to-face interview instead. All other requirements remain the same. The only reason that face-to-face interview is now done is they need to make sure of cognitive status, and at age 65 is where most of the carriers have determined is the best place to actually make that switch over from a phone health interview to a face-to-face meeting with the client. Now, we are in coronavirus territory right now, so there are some restrictions going on regarding underwriting. The over age 65 requiring a face-to-face, obviously face-to-face is not something that's very easy to get done with the coronavirus running around right now. So the carriers have mostly opted to postpone any cases that require a face-to-face. This does not mean they are not getting insurance. It just means they're waiting until the virus itself is kind of toned down a little bit. What you can do is still put in an application, and everything is pretty much put on hold if a face-to-face is required. Just because the doctors can't meet face-to-face right now, it will allow you to save the age. So if their age is about to change, you can get an application in and it will lock in that age. And the instant that they can finally get to a face-to-face is when the case will proceed forward. Otherwise, it will just sit there and wait for the opportunity to advance with the virus dying down. That being said, the entire process is actually usually completed in just a month. Barring any delays in obtaining the records, the interviews are done at the time and date the client even specifies. So if the client wants to have it immediately, it can usually be done within just a few days of their application being submitted. And it's done at their appointment at their own time in their own home. They do not have to go to a doctor's office. They don't have to go to a facility. They actually wind up having the nurse or the interviewer come out to them and meet them in their home. This is why the face-to-face interview has been mostly postponed in our current climate. Parameds, something that we used to have to do back in the day with lab work that requires a blood or urine sample, are no longer done by default on these cases. This is even before coronavirus. We do not usually do a paramed. An underwriter may require one if it's an unusual situation that they've discovered in the records, or they would like to see something, they can request a paramed be added to the records. But that's an unusual situation, and we don't see that. I have not seen a paramed be requested for, I'm going to say, at least 5, 6, 7 years now. It's very unlikely that a paramed will be done. More often, they will go back and request additional records from the doctors, or if they see a doctor come in with one APS report that has another doctor's name inside it, they went to go see a specialist that may not have been disclosed originally on the application. That can delay it because they're going to have to go out and get that second APS from the other doctor that was the specialist. When completing an application, that's where that is very important. If they can provide as much medical information on the application, including every specialist that they've seen, that helps a lot because they can actually get the APSs going from both doctors at the same time, and we don't have any additional delay there. So underwriting can be a very short period of time, usually simple for the client to complete with minimal fuss, and usually done within a month from the time that the application comes in to the time that the actual case comes out at the other end as having a decision on it. However, if they are not agreeable to having the underwriting done, if they still think that this is too invasive a process, again, a product like an annuity-based LTC program that we were talking about in the previous slide may be a solution. One where it is now an annuity that has an LTC component attached to it. Because it's an annuity, it's extremely limited in its underwriting requirements, and we can sail through a lot easier than we can with other products. Now let's get into some more of the who's going to take care of me excuses. There's a couple here. First one is the government will take care of me. This myth keeps popping up that the government is going to take care of me. I'll be fine. Well, the government-run healthcare system has been in the news a lot lately, due to this being an election year, with Medicare for all being the common chant that we hear. But there's a flaw in this, especially when it comes to long-term care. First, whoops, it danced on me there. First, Medicare doesn't offer long-term care benefits. There are no benefits that come out of long-term care for a nursing home or an assisted living facility. You're out of luck with Medicare. Medicare is primarily health insurance only, plain and simple. And like health insurance, there's no coverage for a long-term care facility. It's designed to help you get well, not to treat you over a condition that's going to last forever. Second, Medicaid. While Medicaid does offer LTC benefits, you have to jump through several hoops to obtain them. Most notably, you'll need to spend down your assets. There's a limit to how much assets you can have and how much your income is with Medicaid. You're also limited to Medicaid-approved care and facilities. This means the care you may want or the care that you would like to try may not be approved by the government. It may not be authorized by the government, and they may force you into a different direction. Finally, your decisions are no longer your own. Because the government now controls what happens to you, what facilities you go to, and where you receive your care and what care you're actually receiving, the government now will tell you what you need to do. If the government thinks you need to be in a specific facility or you need to be receiving a specific care, that's where they're going to put you. They're not going to approve anything else. All of these add up to a lack of control over your own finances and over your own care choices. So, as a rebuttal to this, are your clients willing to give up their control of which care they're receiving and where they're receiving it from? They are basically at the mercy of whatever the government decides to do at that point in time. Now, I've had experience with this because of my mother. For those of you who are new here, my mother was diagnosed with Alzheimer's about 2.5 years ago, and she did not have a long-term care insurance policy. I had to rely on the government to provide care. Luckily, here in Arizona, we have a program that is second to none, I like to think, as far as their Medicaid benefits. State runs long-term care insurance on there. We actually were able to provide her with an assisted living facility that was a fairly nice facility that was paid for by Medicaid. But again, it was an approved list. I could not choose where I wanted her to go. The places we were looking at were not available to us. And the options for care that we were originally looking at were not available to us. We also had to jump through a numerous amount of hoops in order to get to that level of care that we wanted and that she needed. And the whole process wound up taking over a year from the time that we applied with her actually needing care to the time that she managed to finally get into a facility. So really, saying the government is going to take care of you, that's very oversimplified compared to what actually is going to happen. The second excuse in this category is my family will take care of me. Say the government's not going to take care of me, my family will take care of me. Well, the rebuttal to this particular excuse is actually a series of questions. First, are you sure they're willing? Are you sure the family is going to be willing to take care of you? A lot of work is required when caring for someone. I have personal experience in this as well with my mother, who I had to care for 2 years. First year while she was not yet to the point where she needed to be in a facility, and the second year while actually waiting for the government to approve her care. She never planned for long-term care. She was here at home, and I still had to take care of her when I could, and it's a lot of work. And the worst part is you need to help them with their everyday tasks, which can be very uncomfortable. These activities of daily living, which if you aren't familiar with from our previous episode, the 6 activities, toileting, bathing, transferring, bedding, eating, the list is very personal. So activities like toileting and bathing, helping them get in and out of the bath, bathing them, helping them with the toilet, can be very uncomfortable for family members to help with. It's not something that they are happy doing. They also need to be trained. Providing care is not easy, and if you're dealing with specific health challenges like Alzheimer's disease, knowing how to handle the patient can make all the difference in their care. It can help the disease not go downhill quite as fast if they are treated properly. Next, what about the caregiver's own health? Evidence shows that most caregivers are ill prepared for their role, contributing to their own health issues. A substantial body of research shows that family members who provide care to individuals with chronic or disabling conditions are themselves at risk. Emotional, mental, physical health problems all arise from complex caregiving situations and strains on the caregiver on caring for frail and disabled relatives. 40 to 70% of caregivers have clinically significant symptoms of depression. Just having to deal with their family members' failing health on a daily basis can be pretty dramatic. 25 to 50% of them meet the diagnostic criteria for major depression. They actually are clinically depressed. Over 50% of caregivers say providing care has created one of the following conditions: a loss of self-identity, lower levels of self-esteem, constantly having to work, or outright exhaustion. Most of them report going to bed completely exhausted and drained, which is not healthy. I can actually identify with a couple of those in that list from having to deal with my mom for 2 years and having to care for her. Finally, with all these points, there's the bigger one of, caregivers experience chronic stress, may be at a greater risk for cognitive decline themselves. They may become the patient if they continue to have to provide care and they aren't up to the task. Are you are your clients willing to put that on their family members? It's easy to say my family will take care of me, but are they prepared for that? And with all that, can they afford it? Providing care often means they're going to be leaving their current paying job, since providing care can be a 24-hour, 7-day-a-week job in itself. Even worse, their health could deteriorate. If they don't leave their current paying job, they may need to take more time off of it in order than they did to recover their own health. They may become sick themselves. They may have doctor's appointments themselves just because their own health is now at risk from having to spend so much time caring for their sick relatives. All these questions need to be asked before your client assumes their family will take care of them, because most likely their family is unprepared. Their family may say, oh yeah, we can take care of mom, or we can take care of dad, but are they really sure of what's coming and what they can handle? The LTC industry has received a bit of a black eye in recent years because of this one, regarding historically significant increases to our in-force policies that are out there in the marketplace. So this excuse has been cropping up occasionally. Not so much recently because our rate increases haven't happened in such a significant amount, but 5 years ago, this was pretty significant news. The good news is that there's a very easy rebuttal to this, and it actually is in every application packet from the carriers. The personal worksheet portion of all traditional LTC policies has a state requirement of listing the history of rate increases in the products sold within that state. Those rate history tables are going to be found right up front in every policy on their personal worksheet. These tables are great at showing a very stable picture of today's product lines. All of the current product series introduced since 2009 or later, so we're talking about products that were developed and first went on sale in 2009 and continue to be sold today, or generations after in the same series, that's 1 decade of history. These people of 2009 or later, anyone that purchased a policy in 2009 or later has not seen a rate increases. There have been no rate increases on the current series of product. That is a decade of stability. So we're very comfortable with where our rates are now, with where the carriers have placed their rates and where the actuaries have finally figured out the best way to price these products. But if that's the case, what are all these rate increases we're hearing in the news? What are the things that we heard 5 years ago about rate increases that would have been within that decade of stability that I just talked about? Well, they are all on older products. We're talking about policies that were sold 15, 20 years ago that were incredibly underpriced. The actuaries really didn't know how long-term care was going to be purchased or sold, or how it was going to be held on to by so many people, how many people were actually going to use their policies. They were expecting a strong lapse rate that didn't happen. The cost of care also went skyrocketing through the roof that nobody had really anticipated, and as a result, the policies were not providing enough money anymore to provide the care that needed to happen, so they had to raise rates. If you're wondering just how underpriced those products were, those older products, the rate increases that we saw, we actually had several people come in and say, I just got a rate increase notice. There's a 40% rate increase on my policy. I can't afford this now. Let's look at something new and go from there. The instant we looked at new policies and tried to compare them up against the older rates, even with the rate increase, the new policies are priced so much more accurately. They don't come anywhere near what the rate is on the older ones, even with the rate increase. The older ones are just so much cheaper that if you've got one and you're getting a rate increase, chances are pay the rate increase. It's still a significant savings over today's policies. So you really, if you've got clients that are coming back in saying, what did you sell me? Why is this thing a massive rate increase on this? You can tell them that their policy is still dramatically underpriced compared to today's market conditions and the current market values of these products. So they have an excellent deal, and it's highly recommended that they keep that policy. It also usually has benefits on it that aren't available with today's policies either, but that's a whole other topic of conversation there. But really, today's policies are extremely stable. So while we've had some rate increases occurring in the news, they are not on today's current product series. And we have the rate stability tables, the rate history tables to back that up. Now we're getting to some more generic responses here. The dreaded, I'll have to think about it. With this one, we don't really know their objection. They're preferring to keep the objection to themselves. Now, this could be because they're just embarrassed by the objection, or they are uncertain about something in the product, or they're just not really there yet, ready to buy. So for this one, we turned to our experts in the field and asked how they handle, I have to think about it. And the first thing they said was they would ask a series of follow-up questions, like, was there something that you didn't understand? Which usually they reply no to, and that they just want more time, that they understood the policy correctly, which is when you can reply, great, let's set up a follow-up appointment. Let's do a follow-up next week so we can speak again and just review to see if you have any questions have cropped up while you've thought about it for the last week. Then as you're packing up from the appointment, this is another suggestion. As you're packing up from the appointment, say how great it was to meet them, and why don't we follow up again? Was it the money? Was it the money that was the sticking point on this? The it will either answer yes or no. If they answer yes, then you can talk about adjusting the plan to meet their premium needs. Let's go ahead and reduce the benefits a little bit or scale it back a little so that we can get within the premium that they're comfortable with. If they answer no, you have an opportunity to ask more directly what is the objection that they have. If it's not the money, what's the exact objection? This opens up a whole new path. It's going to tell you objections that you may have missed or not keyed in on during the interview in the first place or during the review. If they say they don't have any other objections, then the prospect is not really ready to move forward with the plan as presented. You'll need to find an alternative solution or revisit the topic of long-term care later on down the road. They're just not quite there yet. If they're just kind of, I'll have to think about it, but they really don't have an objection, they may or they may not be ready. Again, follow up in 1 week just to set up another appointment to kind of see how they are. And 1 week seems to be the common time frame that a lot of our guys use, saying that shows some urgency, that they really need to get the policy, but also doesn't crowd them too much, saying we really need to let's have an appointment tomorrow. That's too soon. The final objection we're going to look at today is a direct follow-up to what may have been revealed in the last one, and that's regarding the money. I can't afford long-term care insurance. Well, the truth is they can't afford not to have long-term care insurance. The cost of care versus the cost of insurance, the cost of care is significantly higher than the premiums that are going to be required to cover their level of care. As the cost of care goes up, so will their inability to cover it. So that's only going to get worse. Wouldn't it be better to have a policy that can help cover that deficit? The results is a question of whether they're willing to pay $7,000 per month in benefits versus $4,000 per year in premiums, they're going to cover far more than $7,000 per month in benefits. So you look at the total amount of money being spent on the policy, and you wonder, what about the total amount of money that my cost of care is going to cost me? People aren't really quite there as far as, how much truly is covered by these policies. It's not just assisted living, or excuse me, not just nursing home. It is assisted living. It is a home care at home before they even need to go to a facility. Just a companion, adult daycare maybe, or just some type of homemaker or home care at home to help them get over the day with some daily activities that they may not be able to do on their own anymore. If that $4,000 per year is outside the budget, then we can go back and again adjust the plan. There are many sliders and dials on long-term care policies. Everything from how long it's going to run to how much the monthly benefit is, inflation on it, whether or not we're adding elimination periods that are larger or shorter, or adding a 0-day home health care. If we're working with couples, there's the shared care option that we can turn on and off. There are a bunch of things that we can adjust on any given policy so that we can build one that's within their budget and yet still provide some care, some coverage for their future care needs. Remember that percentage from before. 7 out of 10 people are going to need care. So they really should have some plan in place to help them with that. So with that, we're going to wrap up today's webinar. We went about 37 minutes or so today, so a little on the shorter side. These are the 9 most common objections that we've heard from our field force. If you have run across other objections and you don't know how to overcome them, we'd love to hear from you and to help you out. The carriers also provide a lot of back-end support in regards to helping clients come to a decision about their long-term care plan. We have lots of marketing materials that can help not only get the talk started as far as how to begin the approach to offering long-term care, but also how to overcome their objections to long-term care and the challenges of providing them with an adequate policy that they are comfortable with. If you have any questions about overcoming objections or about working with us here at Heartland LTC, we're going to go ahead and open up the lines now. You can also use the chat box that's on the screen as well. If you have any questions in that panel, you can click the chat and type your message in there. Or if you have something that is a little bit more client specific that you'd like to discuss in private, you can feel free to contact me after today's webinar to discuss a specific client situation. My contact information is on the screen there, and we're available all the time to answer any questions that you may have regarding long-term care. So let's see, does anyone have any questions regarding objections and overcoming them today? Okay, I'm not seeing any questions come through on the chat, and don't see any questions coming the other way either. So looks like I did my job good today. Seeing no questions, I'd like to thank you all for attending today's webinar. We hope to see you at our next LTC101 class that is projected to be in 2 weeks. That'll be our final episode in the series, episode 5. If you have further questions about today's topic or just questions about long-term care in general or about Heartland in general, feel free to contact me after today's webinar. Phone numbers and email are on the screen there, as I've said. So appreciate everyone's time today. Thank you all for attending us. We hope you have a great day and a great rest of your week.